Yes.
Can you, awesome job, by the way.
Thanks.
Can you apply your pricing model towards different instruments such as swaps or foreign exchange?
It all depends on the pricing models themselves. I'm pretty sure for the Black-Scholes model that it's specifically designed to represent equities, but I don't know for sure. There's a third method of pricing options called a Monte Carlo simulation, for which I briefly played around with trying to build a model for, and then I just didn't have the time because I wanted to get the web app finished. But that, I think, because it takes many different other types of inputs, and you can use it to price other exotic derivatives and Bermudan options and all kinds of crazy stuff. So if you wanted to do that, that would be the pricing model I would implement. But one of the problems I ran into, especially with the binomial tree, is that the math underlying those models is just above anything I've done before. So we'll see. But that's what I would do if I wanted to do that. Yep.
How much math have you done? How much math was involved in Black-Scholes?
Right. Well, I've gone as far as calculus too, but mathematically I was pretty intimidated, especially by the binomial tree. But the good thing with the Black-Scholes model, which I have, let's see, here it is, with the Black-Scholes model, is that a lot of the math can be automated pretty simply by using the SciPy library, which uses, there's two functions. One is the probability density function, and I'm not sure I forget what the second one is, but it uses two of those functions to very efficiently give you those two derivatives. So manually, I didn't have to do any pencil and paper calculus to figure this stuff out. But yeah, so mathematically it was intimidating. But luckily there were several other implementations of these models online, and I kind of used those as guides to see which approach to take as far as pricing. So. What else?
What was the hardest thing you ran into in the project, would you say?
Let's think. Well, a couple things. One of the more interesting issues is I spent an inordinate amount of time trying to develop a good scale for the graph. Originally, I was trying to have my data frame calculate up to 4,000 prices, and it was taking a really long time. And I'm wondering, how am I going to make this manageable? And then it turned out that C3.js doesn't really want to deal with more than 500 data points at a time, so I made the scale much bigger than I thought it was going to be, but figuring that out was difficult. And then probably the hardest part was working with the Greek values in both pricing models. I spent several hours a couple weeks ago working just on the value for theta in Black-Scholes, because with all of these different calculations is just multiplying float after float after float, and sometimes exponentiating with floats. I would run the calculation. I knew I have it all set up correctly, but then it would have a huge tracking error. And when I would go online and check the Black-Scholes calculator, which blacklisted my IP address, by the way, because I pinged it too many times, when I checked it, the value was off, and I had no idea why. And it turned out I was just multiplying too many floats together. And what I did is I abstracted these exponentiations and used a density function from SciPy to.
Can you zoom in a little bit?
Yeah. I just abstracted a little bit of the logic, and that resulted in a much smaller tracking error. And then dealing with the Greek values in the binomial tree was also a mess, because instead of just using a derivative, they take certain node values. So they go through the tree and they say, to calculate this Greek value, take this node and this node and this node, and do some stuff with it and get that value. So playing around with it was, when you're dealing with really small decimal numbers and that you have large margins of errors, it's kind of pain. But yeah, so I think that was probably the hardest part. Yeah.
So to expand on that question, actually, I guess, did you get a chance, or were you able to do any backtesting to see the model, to see if I don't know, a couple months or a couple of years, to see that data actually matches the real market values that.
Oh, right. Oh, you mean just seeing if the theoretical prices are. I didn't do any of that. I'm sorry?
Is your model capable of doing that?
Well, backtesting usually means you're testing you're testing a certain strategy or model against the market, which for option strategies is not, that doesn't really, there's nothing to really backtest. But you actually bring up something really interesting, which is how accurate are these theoretical prices? And one of the things that I really faced was when designing this application was, do I want to use these theoretical models which give you reasonable prices, but at the end of the day it's just a model, or do I want to try to pull real-time options data and let the user pick a stock and then say, here's what the options chain has for that specific stock, then build a strategy. And I decided not to do that because for all of the data that I could find that gives you options chain information, either it was in a format that was nearly impossible to process, or I'd have to scrape it from the web, which would have been a big detour, or I'd have to pay a lot of money, and I could not do that. So I decided to use the theoretical models, but they exist and people use them in modeling in quantitative finance because they offer a pretty good approximation. And when the goal of this application is not to provide financial advice. Like, you're not going to look at this graph and decide, like, here's what I want to do with my money. It's a simulator, really, of if I were to put together this strategy, what would it look like? And at that point, it's not as important relatively if the prices are exactly what they are in real life. So, in my opinion. Anyone else? All right, cool. Thank you.
Did you think about bringing in a little bit of just a few points of like real-time data into it, like, you know, factoring in momentum or something like that?
Momentum? I don't know what that is.
Like in the direction of the market movement, right?
Oh, okay.
The options models will never be on point if you're just doing like a calculation.
Right. They're very static.
Right.
And actually, if you see on the x-axis here, it says value of underlying instrument at first expiration, and that's because the only way to model option strategies that have multiple expiration dates is to go to the first expiration date, calculate the profit for the options that expire there, and then reprice everything after that with the assumptions that volatility stays the same, the risk-free rate stays the same, dividend yield stays the same. So it's all very static, and I would like to take that into account, but the pricing models themselves only take those sets of variables. And so if I wanted to take into account more variables in the pricing model itself, I'd have to do something like a Monte Carlo simulation, from what I could learn, I think. So, all right, thank you.